personally, in order to really trail a stop loss. I have my stop above here. I'm glad I didn't trim it or trail it into profit here today, right? Because I probably would have gotten whipped out. I'm waiting for a closure below this target range in order to start trailing a stop. Guys, we're going to take a quick break, and then we've got Chris Pulver joining the show. Last thing I'll say is while we transition here to the next portion of the show, Chris and I are going to chat markets for a few minutes. Before we do that, just a reminder that if you'd like to try out the tool, it is free this week until Friday. You can get access to the Edge Finder free week event by filling out this form that we're going to drop here in the chat so that you can check it out for yourself. Stay tuned. We'll be right back with Chris Pulver just after this.
Good morning, everybody. Happy Tuesday. How we doing? It is just after 10:15. Taking a look at the currency strength chart. We've got some aggressive jockeying this morning. Japanese yen all over the place. Pound up, dollar dropping on the news this morning. We had JOLTS job openings, and I believe we had, what was the other one? Consumer confidence.
Yep.
Consumer confidence came in way, way higher than expected, but JOLTS was a miss. Nick, they had a pretty strong revision, man. We were down just under 200,000 on the revision and missed by about 500,000 jobs on the JOLTS report. That's pretty substantial.
Chris is definitely, and what surprised me by that is that the Nasdaq and S&P kind of held up in that, but at the same time, yields didn't even really go down. So I'm a little confused by that, right? You would think like, oh, pop on cool jobs data, that means maybe they cut or cut rates or keep the rate cuts coming kind of thing. But we didn't even really see yields drop yet. The market kind of popped. And look at gold acting like, it loves that. So interesting to see. Bonds are trading so uniquely right now, Chris.
I mean, the yield situation is basically calling the Fed's bluff. They're going to say that this entire movement is going to be inflationary, and the Fed's going to have to do something to basically do what we said is going to happen all along, which is they're going to break something. The bond market's going to break something. The bond market's going to price in something like things are rougher.
And gold's telling you that too, right?
If
something's going to break, gold is warning of that potential. Chris, I want to talk about all these markets, but I have to ask you to back me up on this thought process I had just before you joined on. Okay. I said, I mentioned that for 99% of people, I would actually not recommend trading. Like trading is so difficult to try and get to that point. The reason I bring that up is because I think you kind of had to. I said I think I probably would classify myself as slightly insane to do this for so long and to carve out, making money in the markets. It's been so incredibly hard. Do you feel the same way? Do you have to be? Would you classify yourself as slightly insane? Because I would call you slightly insane, like myself.
I don't know if I don't think I call myself insane. I think I call myself just really competitive, because at the end of the day, this is a competitive streak where, I like to win. And I realize like trading is not about winning. It's about making money. It's not about being right. It's about making money. So that's part of the journey that you have as you are a trader, is you realize that it doesn't matter if you want to be right for your ego. It feels good, but it doesn't reward you necessarily, because you could justify.
Maybe the phrasing then is insanely competitive.
There you go.
That's probably valid, and it's why but not only that. The last thing I want to add to that, you have to be insanely competitive, but you also have to like really, really like this stuff. Like it's beyond just like oh yeah, I'm competitive and I like to challenge, but you actually you could employ those resources in engineering and becoming a doctor, a lawyer. You could, there's many ways you could employ that competitive nature. You have to really love learning about financial markets, price action, technicals. So yeah, I just wanted to end that conversation.
So I'd say full-time trading, you're absolutely right. But having some type of passive approach where, example would be this. If you just learn how to trade a basic option trade, a basic credit spread, and you trade that on the index over and over again, that there's nothing wrong with that. You don't have to be super competitive. You don't have to be knowing everything about the market. It's like, if you understand that there's defined risk in this trade, the most you can lose is what is traded up front. The most you can win is what's already predetermined. And you can do this consistently every week, every month, every quarter, whatever you're comfortable with. And if you give it time, I mean, question here, Nick, do you think that the S&P, let me show my my screen here. Or you've got it. Did I already have it? Was
I
it
got
up?
Nasdaq pulled up.
Okay.
Um,
So where do you think the S&P is going to be in 10 years? Higher or lower?
if it's lower, something went terribly, terribly wrong. So
Exactly.
probably higher.
Probably higher. I mean, we've mentioned Tom Lee on the show before. I mean, Tom Lee's talking about a doubling or tripling the S&P over the next 5 or 10 years. I mean, if the S&P is going to get to 10,000, it might be after a pullback to 4,000, right? It might be
Sure.
after a pullback to 4,500, but
Yep.
more than likely, it is designed to be at 7,500, 8,000, 9,000, 10,000 as the haystack keeps improving, as better companies get stronger. This whole thing with AI is either the greatest amount of expenditure, with the risk being possibly not being able to provide enough energy to support AI or support the energy needed to run these crazy servers and whatever we're building out there in capex. And I also wonder if it's easier to trade AI than trying to get into like these crazy private equity plays. AI could be as simple as trading the Nasdaq and trading your Mag 7. And I hate to say it because it's so concentrated, it feels like it's too easy. But at least the Nasdaq would be the top tech stocks. I mean, the S&P is going to be your broader basket. Your Dow is going to be your price weighted and your bellwethers. But the Nasdaq is going to be probably your index that's better I'd say positioned for tech and deflationary pressures. And if we have this AI stuff that's really causing more efficiency, better profit margins, the Nasdaq itself is a pretty good way to be playing it. So
I
um,
agree. There's so many different ways to play it. And Chris, we've got that webinar coming up. Maybe
yeah,
Chandler or James, you guys could drop the webinar link for us in the chat. Chris and I are doing a webinar talking about like top ideas for 2025, but that's a subject that I definitely think we should dive into in the conversation is like, okay, how to play AI. Yes, you could go out way on the risk curve and you could say, I want to buy unprofitable tech companies that are promising AI revolution. You
yep,
could do that, but you could also look at energy. You could also maybe look at like pseudo ideas like Bitcoin, even. Like, what if
mhm,
we, look at, just internet businesses in general? What if you're looking at, there's so many different ways. As you mentioned, maybe the most diversified way is to trade NAS and play the cues and just say, look, the cream of the crop will rise to the top out of
mhm.
the cues. That's just how it always goes. As you mentioned, these things are designed to go up over time. Now you can greatly outperform them by picking the winners, but that is of course easier said than done.
Yeah, and that's not guaranteed, and honestly, that's way harder to do in the long run. Picking
Yeah,
stocks is way harder
so
to do
difficult.
consistently because if you look and see, I mean, you can go back and if you really want to nerd out on this, go back like 30 years and look at when the S&P or the SPY was first created, the QQQ was first created.
Yep.
Look and see what the top 10 stocks were, the top 10 holdings. This is market cap weighted, right? Look at those top 10 and look at the percentages and go from day one of the SPY and Qs all the way to now and see that it's not the same companies. I mean, the Mag 7's been a
Yeah.
pretty good runner. We've had like a decade essentially of these tech companies leading the way. But before that, your top 10 holdings, your best performers were all different names and all different sizes. And so that's why the long run stock picking is challenging because it's always going to change and always going to ebb and flow.
Chris, that to that point, I recently saw something about the Nasdaq 100 index only contains, and I somebody please fact check me on this, but I believe it's something like the Nasdaq 100 index since inception. It's 100 stocks, right? It
Mhm.
only has like 5 or 6 of the initial companies, and maybe the ones that are in there that might not surprise you are. I think Costco is one of them. There's like a Costco is actually in the Nasdaq, which I didn't know until recently. But there's a couple names that have been in there forever. But the vast majority, as you just mentioned, the way stocks, how the bricks fall, if you will, is that over time most companies fall off the wagon. And
Mhm.
the wagon keeps rolling, but new players are in it. I mean, I love to trade the indices for that reason. And most of what I do in individual stocks at this point, Chris, is now options plays. I mean, I'm doing the wheel strategy on a couple, a diversified basket of some of the biggest conglomerate companies. That being said, even those can fall off, right?
Yeah.
And what's the one, the 2001 stock that was ginormous that fell off?
Cisco
Cisco, yeah,
still
Cisco.
70% away from the all-time highs.
Uh, yeah, guys, we have to remember that when you look at Cisco, this is a history lesson that's very important. Cisco at one point was the Nvidia of the days of past, right? Look at what happened back in the 90s. It just went. I mean, if you were long this stock, just an 87,000% gain, like just a casual. So my point with that is that at the 2001 crash, it lost 90% of its value and has still been working to get back to that all-time high. So just something to think about. But good points there, Chris, on just the importance of understanding the index versus individual stocks. And I guess next question for you: what's gold doing? Is gold just going to have a melt up year next year too?
I don't know how long this can keep going, but I mean, we've had a decent stretch. The last time we tested on the daily time frame, this is the 200 moving average. We're up 269 bars. It's not crazy overextended, and on top of that, we keep having these like pushes and pauses, pushes and pauses. Now it's getting more and more. Um, it's getting faster. I mean, we had a long pause cycle here, a long pause cycle here. This was shorter. This was shorter. I mean, I I guess if I look at this chart and all we test is like the 21 and we just keep getting what I'm looking at here, Nick, is the further we get stretched away from the 200, that's probably what I'm looking to call more of the top.
Yeah.
How would you read? So in Edge Finder Pro, I looked at this morning. Where did it go? Right here. So am I reading this right? That if I'm looking at the COT
Yep.
smart money indicator, that right now it shows that retail is still lower than the net positioning of the COT, which means
Yeah.
it's more institutional flows right now than it is retail. Yes?
Yeah, and that's what's interesting is when you look at this chart, you got the blue line going up and up and up. That's COT week to week filings
Yes.
showing institutional money has been, to be fair, if we could drag it out to 2023, I don't think we can on this chart. I don't think it's functional right now. But the 2023 showed the same thing. It was like buy, 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 buy. That actually interesting at the very end of your thing there, Chris. You got the blue ticking lower. If if that stays the case for a little bit, maybe institutional money's played their hand. I'm not sure.
Well, because I was wondering, I think the toppiness would be if retail gets bigger into gold. I mean,
Oh yeah.
we have been talking about gold all year, but obviously this isn't the entire retail crowd. We've got a decent chunk of, we get great viewers here on the network. But when I look at this, I wouldn't really be super bearish on gold unless we have just an absolute monster blow off move and it stretches so far away that it's like, okay, now we're expecting to some type of correction, some type of reversion. Because
Yeah.
usually what happens is if we have a bull market like this bull market can just stay the course and look pretty healthy for a while. What gets to the point where we have to be a little bit more protective would be if this thing just blows off and gets so vertical that I'd be more concerned about how that ends up correcting and reverting. So until we get either a blow off top, which we can then move stop losses along the way and just trap it. Otherwise, I think this is just up and steady, and our quicker moving averages will catch up, and slow and steady. To me, it still looks pretty good.
My
And I don't
question
know what the alternative
too.
is. Yeah, go ahead.
My question to you is also think about this: is gold, not to be, we've been predominantly cautiously bullish for most of the year on the indices, but
Yeah.
does this rally in gold tell you um, something is not right to the market? I mean, not to whip out that there's always, every time gold rallies, somebody will call out on Twitter. They'll be like, "Oh, gold's telling you it's going to crash," and it's been rallying all year, but so have stocks. But at some point, when you get such an up move, um, we can go back to like 2008, for example, and gold was rallying into that ginormous crash too. I mean, I believe I'm right in that. Yeah, I mean, look at this. So 2007, markets started sniffing out something wasn't right. Gold was ripping to higher highs, and then sure enough, 2008, huge crashes, and gold did also see a big correction, but it wasn't nearly
Sure.
as big as the Nasdaq and S&P.
One thing that's interesting, so I just typed this out. Gold outperforming indexes. Indexes are up, dollar strong, yields are up, oil's down, growth is better than value right now. Value is still underperforming. Utilities, financials are some of the top sectors performing this year. There's
Mhm.
never ever been a year where gold has been 25% up and the index has been 20% up. Never. Now it's not
Interesting.
there. It's not there yet. Like we
Yeah.
have gold up over around 30%, but indexes are in the low 20s. So I do wonder. I mean, if gold stays where it is and the indexes creep higher, we're doing something that's never been done before, which means it's hard to model that. It's hard to model and say, like, well, this is what's going to happen because we've
Yeah.
seen it before. We've not seen this before. If gold is currently on pace to continue to go higher and it's 30+% for the year, silver, same thing, Bitcoin's up as well. And now you talk about the indexes matching that, getting 25+% and having this year-end rally with Q4 and the holiday drifts of November, December. It's never happened before. So
Yeah.
I don't know what to make of that outside of this stuff isn't great. Like having, dollar from weak to strong, having yields up, and essentially, like I said, I think the bond market is trying to call the Fed's bluff where I don't think the Fed can be as dovish as they say they're going to be outside of, yes, they've telegraphed that they're going to cut November, December. The probability
Mhm.
seems pretty high. But going into 2025, I mean, I guess the answer here, Nick, is everything we're doing right now from just printing and adding global liquidity and adding money supply and trying to basically inflate our way through the debt. That's the only way that we're going to tame this is we have to somehow inflate and grow our way through the debt
Mm.
because we can't cut spending. I mean, right now it's like in
Yeah.
order for the US GDP to grow, we have to spend, I think it's 1.5 to 2 times the dollar amount on debt in order to produce that same type of dollar amount for GDP.
Yeah, it's a interesting scenario, with what you just mapped out for us. You've got some traditionally defensive stuff
Yep.
doing quite well, and meanwhile, stocks are also doing well. I would not be surprised if next year one of those stories cracks. I don't know exactly which one it would
Yep.
be. My But
Bonds.
again, keep an eye on gold. I mean, if gold
Yeah.
if gold just does not quit and it just screams into the new year, in 2008, you had a big sell-off in everything, but then you had gold rush out of that drawdown very quickly.
Right.
That's typically, we saw that in 2020 as well. If you're somebody who watches gold like a hawk, then you know that in 2020 we had a similar scenario where, just like everything else, I went way too far. In 2020, you had the pullback, but it's so brief. Look at this. In
It
2020,
was
it
2
was
weeks,
so
man. It was
brief.
over in 2 weeks in gold, down 14.6% for that top to bottom in 2 weeks, and then that bottom was in.
And I remember I made videos during that time being like, guys, stocks are up, but gold is up way more. Gold was up 41% from the lows very quickly.
Yep.
Eventually stocks did catch up and take over, but
Mhm.
it is something that, if you get like a huge scare in the market and a big drop, gold historically actually has a really good rebound in sort of a fear recession environment. So
Yeah.
just interesting to
I wonder too
study.
if we look at if you're really zooming out on your gold chart, go back to like 2000, Nick. If you can go back to 2000, or I can show it here from
Yeah.
2000. If this is a wave one and this is a wave two, and we're still kind of working our way through a wave three, wave three is typically the strongest wave to trade. And the nice thing is if this is accurate, and this may not be, but if this is one, two, three, four is usually a pause. Four is usually pretty quiet. Four rarely comes back all the way to this previous high. So four could be just a little pullback, and then five means we could be way higher in gold, way higher in gold.
Yeah.
I mean, think about the potential wealth generation of if people are long gold as an inflation hedge, or long gold as a safe haven, or long gold because it's better than the dollar, an alternative to the dollar. You're so happy that you're making that play right now. If
Sure.
you're in the same mindset of Bitcoin being that alternative and it's more digital and this is the internet 3.0 and blah, 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 like Bitcoin's that same alternative. So gold and Bitcoin, just those two alone could be helping a lot of traders out there, or investors rather, get ahead in some way, shape, or form. If they're, I don't know. I mean, I don't know if everyone is always into indexing. I don't know if everyone's always into stock picking. I don't know if anyone cares that much, but it's like, what's been easy? If you're long gold, long Bitcoin, and just long an index, you're doing okay. It
Yeah.
doesn't have to be crazy complicated. It really doesn't have to be. So,
Chris, are you how's your crypto stuff looking? I've got a
pretty good.
Bitcoin long. I'm riding this
Yeah.
with you right now.
Yep. So Bitcoin. So I mean, I wish I had more stock in MicroStrategy. That's been the one that's like, what are you doing, MicroStrategy? Now I expect it to be volatile.
Yeah.
I mean, it's already pulled back a little bit today. It was up like 8 or 9% this morning. Now it's down. It's pretty much flat. I hope there's a pullback here. I've got a lot of income trades on MicroStrategy because the premiums are so good. I've dollar cost average in with fractional shares, but I've never really jumped in because it wasn't that long ago. I mean, the split was in August. I mean, August 8th was 3 days after that, nonsense from the Japanese yen deleveraging, the August 5th bottom. But so I didn't go hog wild on a dollar cost averaging or adding more, especially after the split. But it was a $2,000 stock or at least a $1,800 stock. So once they split, I'm like, well, here's like $1,000 at MicroStrategy, but it's up a lot. It's just not a big position. So meanwhile, I'm taking advantage of the premiums. I
Do you
probably
have
have.
any BITO or anything?
I do. Yeah, I've got.
I've
I'll
got
right here.
IBIT long, Chris, and I
Yep.
also sold puts on BITO. So
Nice.
Bitcoin is being nice to me right now.
Yep. So I've got a long call out to 2026 on BITO, and I have a bunch of puts in here below the $16 mark on BITO. Eventually, we will see option trading on IBIT and probably FBTC. Those have to wait through it's the what is it? The OCC and the CFTC. Once they get approved, then we'll see some option trading there. But yeah, IBIT is up. Let me go to the position here. Should be at least climbing up to some decent highs.
IBIT,
IBIT.
you just have some shares.
I have some shares, yeah. So IBIT, let me go to it right here. So IBIT is up around 10 grand in my position
Nice.
right now. Yep, over 10 grand. So I have
I'm
some
about
shares.
to
I'm just
same.
letting it run. It's been dollar cost averaging throughout the year with that accumulation cycle we saw in Bitcoin. So through all this chop, basically I was just buying at these equal lows. So I had an
Very
equal
nice.
low, had an equal low, sat on some drawdowns. It's gained, and now it's hopefully gaining more. If it goes higher, great. I've already got this on my chart here. This green box is measuring out roughly if Bitcoin hits 100K, which I have Bitcoin measured symmetrically to like
Where
107,
IBIT would go
IBIT would roughly
percentage
be
wise.
around $57 and change. Yeah.
Okay. Yeah, cool. Yeah, no, I took a trade. It popped up on the Edge Finder. I liked the momentum that was starting to pick up on Bitcoin. I
Yep.
went long IBIT as well. So I've got a position, and I don't know. I think I said this earlier. Not financial advice. You shouldn't touch crypto. You probably lose all your money. But I like Bitcoin. I think it has a good chance of having a bigger run up here. And if I'm right, hopefully we make some good money. And if we're wrong, I'll lose money. So here's the thought though, as you just pointed out, if we come up and test those highs, which I think we're likely to at least test those highs, we'll see if that happens. Question is, do we actually get a break and close above that level and start to see finally a break of this long-term consolidation? But I like the way you've played that, just kind of throughout the year, picking it up when it's fallen, dollar cost averaging a little bit, building into this idea. But yeah, I mean, to your point, keeping it really simple, Bitcoin has been a very top performing thing. I think there's a ton of risk in Bitcoin, but that is also why the reward has been so massive for those who have held it. Now, again, that could change. Bitcoin could crash to zero,
Yep.
but I think that you and I have had this conversation before. You call it risk capital. I like that term, that
Hmm.
phrase of basically saying this is a potential alpha generator in your account, which
Yep.
alpha essentially means beating the market.
Yep.
If you're going to beat the market, one of the ways is to potentially take higher risk, higher reward plays like a Bitcoin to see if you catch another run up. One run up in Bitcoin could change your performance, forever, right? Now, of course, so could a
Absolutely.
big crash, but we have to be aware of both sides.
Yeah. Well, the rule of thumb from Bitcoin is 1% exposure at any point in time since inception would have essentially outperformed the market by double. So the S&P is averaging, 8% a year. You have 1% of your allocated portfolio to Bitcoin, you're averaging about 16% a year. So if you're invested in the SPY, 99%, 1% Bitcoin, you're making 16% gains a year. Like that's pretty impressive. And that's 1%. I personally am more in the 3 to 5% for that exact same reason. So instead of doubling, it's like if I've got, Bitcoin that can help, and it's not the end all be all. Literally until right now, Nick, like my Bitcoin was kind of just sitting there underperforming. I mean, good income plays on MicroStrategy, income plays on Coinbase, but Yeah, I mean, I just kind of bought into the accumulation that we saw. I mean, I'm still waiting to see like do altcoins or Ethereum like other. I mean, Solana I know is another popular one. It's like do those start to pick up and catch up as well, or maybe it's just Bitcoin. I'm mostly in Bitcoin. I don't really care about the altcoins. I haven't cared about them since really the deleveraging we saw back in 2022. So
Over
it's mostly Bitcoin. Yeah.
over our time, just streaming together, Chris, and checking in and stuff, I feel like I've noticed that is a very common theme with a lot of your ideas is like you collect income on them for a while
Hmm.
and you're not so worried about like when the big pop's going to happen or when the big drop's going to happen, but you're kind of there playing the income side of things. And then eventually a move happens and
Yep.
you exit in an organized fashion. I think a lot of times I also notice you've done a lot of contrarian plays, which have worked very well. Like this year, just off top of mind, you've played China correctly. You
Yep.
were building a yen long position when I called you crazy for that, and you were right. Right. So there's been a lot of good plays on that front. Now we both know that nothing is perfect, and there's things that I've messed up this year. Nut trading is not cut and dry, always correct, but it's been interesting just kind of getting to know your trading style over time. And I think there's just things that hopefully the audience can pick up and learn from just by watching and learning.
Sure. I mean, so the China stuff, for example, I mean, I would love to see. I don't really know how long I want to hold on to this. I'm just going to base it on kind of price action. If we
Mhm.
have all the China plays that just rip to the upside, pull back here, stabilize. I mean, JD for this week, if it's above $42 by Friday, I get it called away. I will make around 4 grand just in an income play. I think we talked about that for now 2 or 3 weeks because I just bought the shares, started to do like an aggressive. It was kind of like a buy right strategy where I bought the shares and I sold a cover call against it, and I just wanted to generate the income. So I've already rolled a couple of times. I've rolled it down as well, just in case it wasn't going to be as cooperative and it pulled back deeper. But right now, I could probably roll this out another week and grab another 70, 80, 90 cents of credit, which would improve my bottom line. But I'm not, I don't know. I'm not trying to be super risky. Plus we have the election next week, and I really don't know. I don't know. I don't know what's going to happen with the election stuff. This week is interesting with all the earnings that we have. Um, I think the market is either going to be extremely choppy and volatile. Um, I guess I think the market is better to be choppy and sideways, or even having some pullbacks as we go into the election, as opposed to blowing the top off as we come into the election next week. What do you think? Would you rather see all-time highs right now as we go into next week, Nick, or see some choppiness? What do you think?
I mean, choppiness would be nice. I wouldn't mind pullbacks either. I mean, if it happens, it happens. It's been
Hmm.
such a bizarre 2-year period, and you always want what you don't want. I remember in 2022 being like, man, I just missed the days where the market went up every day. And then now that it happens now, I'm like,
It's the days when the market pulls back.
I miss the days where it would pull back, give me so it's kind of just like one of those things. It's like, we got to play what we're in. And
Yep.
at some point, this will change. At some point, markets won't go up every day. And people who are over leveraged, that's the biggest thing. We don't know when that's going to change. The only thing you know is that if you're over leveraged, when it does change, it's going to hurt. So
Yep.
that's what we can do, I think, in my opinion, to prepare. I do think that going into the election, there's going to be volatility. It's been pretty, even though we've sort of drifted higher, it's still been a choppy, uncertain kind of move higher on things
Hmm.
like the Nasdaq, S&P. So I wouldn't be surprised if you get some flushes lower. But in my opinion, until something changes publicly with the Fed, the bond market's calling the bluff, as you mentioned.
Yep.
But until we see some solid, change in sentiment, market kind of just seems like it wants to drift until that becomes a confirmed idea. But I do think that one of the biggest red flags currently to the market rally is keeping an eye on the bond market, which
Yep.
is rallying like nobody's business,
Yep.
and could cause some uncertainty going into next year.
If you want to watch two levels on the 10-year, if we get back to 5%, that could be a bit of a deal breaker for the equities market. If we get above 5%, it's going to be painful, because if we hit 5.5 to 6%, that could be like full on crash is coming. These would be levels we haven't seen in so long. I mean,
Mm,
when we were coming up to, I mean, look at 2022. We were in a pretty healthy 9-month bear market all throughout 2022, and our bond yields, the 10-year, was ripping higher. Like pretty much the S&P topped out in January of 2022, the Nasdaq topped out in November, December of 2021. All that deleveraging lasted for 9 months. We had a January to September bear market, and yields that entire time were going much, much, much higher. So here we are in September 2022. It was September, October when we finally bottomed in 2023 to get that like Mag 7 kind of rip for Q4. But that was a healthy go on the US 10-year. If we do the same type of thing where we're getting back up to these highs, top here, this is an interesting top in the 10-year yield with the bottom that we saw back in the stock market in October 2023, because the broader market, once we had a Q4 rip in 2022, that would have been all Mag 7. So Mag 7 was what pretty much saved the market in late 2022. And then it became a broader market into May and July of 2023. This was the biggest broad market. This, I'll just put 500 here. Everything ripped Q4 of 2023.
I remember that.
And somehow,
Russell went crazy, like 30%,
right?
I think.
Russell was one of the biggest moves we've seen in like a 3 or 4 week window.
Mm-hmm.
So Mag 7 kind of saved us there. Then we have the 500. Then we have the AI trade, and yields have been pretty much contained. Now, this is why I wonder what happens here. I don't know if the market can go higher if the 10-year yield is going to get better than 5 or 5.5 or 6%. I would say that's probably going to put so much pressure that I don't think we can outgrow it, man. I don't think we can outgrow inflation. I don't think we can. I mean, my gosh, the market I almost feel like the 9% inflation that we actually saw, it doesn't feel as bad as what we're just seeing day in and day out, month in and month out, which is, nobody recognizes this, but 2.4% just shows that it's positive 2.4 year over year. But if we go back in time, it's like 11% higher than where we started with this 2022 to now. It's like inflation is not tamed, and it feels like every single month is just like sticky inflation, higher inflation. And the yields are showing us right now that this move with the Feds cutting to all-time highs and yields going up, inflation is not going to get better. And I don't know what the data is going to show. We have PCE coming on Thursday this week. I'm trying to find a year-over-year PCE, which I saw 2.65 or 2.68, which is supposed to be like the Fed's kind of measure of like, okay, we're at 4.75, we're still restrictive. But this data point to CPI at 2.4, Nick, do you think as we roll into November and we're going to print October CPI, do you think we're going to print 2.4 or less? Because I keep going back to this trueflation thing. I don't think we're going to see 2.4 inflation in maybe in a while, maybe never again. I don't know. Look, this is what scares me. This thing came down. And it's totally third party here, but this thing was down to literally 1%, and now it's up to 2.28. If that's any inclination of what our inflation is doing in real time, we're so far away from that 2.4, 2.5 that I think the scary data would be that all of a sudden our year-over-year prints at like 2.9 or 3% again, and we're just going the complete opposite way.
Yeah, that sort of seems like what the bond market is concerned about with the rise in the 10-year. If they were not concerned about inflation whatsoever, you would think that the 10-year would be staying down here.
Right.
But with this big pop, it's you can write off a little bit of it as being like, well, politicians are both going to spend money and there's going to be but regardless of what you want to call it, it's just the bond market saying, no, if we're going to buy your bonds, we want a higher payment because we're concerned about inflation eating away the returns. So that is what we're looking at. So I do think it is a concern. I think that, when it comes to valuations on the stock market, I think it's very fair to say, with a rising 10-year yield, as you mentioned, I think one of the smarter things that we could do on our chart is go out to the weekly and mark some levels and just say, at 5%, we've got really alarming levels. Above that, we're probably looking at a major market correction. I wouldn't be surprised by a 20% dip if you got, because that would basically slash the hopes for rate cuts, is basically what that story is. Even where we are, rate cuts are going to be starting to get questioned. If they start going up here, then you've got rate cuts probably put on hold. And if you get over here and above, you might be looking at rate hikes. And that's where, the market would have a meltdown, like it would start crying like a little girl.
Well, then, and then if we have a market meltdown, what's the Fed going to try to do? The Fed's going to completely, like, we could have the most messy, like, rate hikes to tame inflation and then rate cuts because the market's tanking or the economy's I mean, this recession that we've just gotten away from, and it's been like this soft, sector by sector rolling recession.
Mm-hmm.
That, I mean, and that's the argument, is everyone said recession was, we've had recessions, man. 2020 was a recession. It was brief because we stimulated our way out of it. 2022 was a rolling recession because every sector felt it differently. So if we have a broad market and everything is down, there's no safe place to invest.
Yeah.
That's what the recession, I think everyone's like trying to talk about, which is, oh, it's 2008 all over again. And the scary part is 2008 at a $700 billion bailout is chump change compared to what we'd probably have to do bazooka wise to get ourselves out of this situation. If
For
we
sure.
wanted to stimulate our way out of, we've increased the debt by $6 or $7 trillion since COVID, right? I mean, we're the clip is about every 45 days, 45 to 60 days, we're adding $1 trillion to our debt. So, I mean, the amount of money to say like, oh yeah, great financial crisis times 2 or 2.0, and now it's a $5 trillion bailout for the US economy, for the airline sector, for banks, for this. And another thing that's also been alarming, have you been watching Buffett? I mean, Berkshire Hathaway is
I know he's
dumping
building
shares
cash,
left and
right?
right. They're raising tons of cash, and they're also
Mhm.
dumping bank stocks. And I wonder if
Bank
they're
of
dumping bank
America.
stocks because of the exposure that banks would have to a potential bond crisis.
Interesting.
So I don't know, and again, that sounds so dark and doomy, and it sucks because I don't want to ever be that trader that's like, that's what I'm talking about, is just where it's all going to oblivion, because you and I are in this space where if that's the world that we're going to embark on, it's not good for anybody. I mean,
Right.
so unless we're talking about full financial market implosion where there's nothing to do other than, go back, and I hope you save your gold bars and your silver bars and you got a ton of canned food storage. If we're going to that type of living, it's like, well, I guess I'm not prepared. But for the financial
Right.
markets to have a reset, fine. We'll find a way to navigate it. We'll find a way to trade through it. The nice thing is I'm sure you have it too. If you have cash at the ready, which is one thing I've been really focused on this year, is having dry powder for the opportunity to buy at better prices. Now, I know that's being said as we're making all-time highs, and it's like, am I missing out? Maybe. But if we have, I mean, and this is why 2020 was such a good opportunity, and 2022 was such a good opportunity, and 2018, after that vol event we had back in January 2018, was such a good opportunity, because every now and then this market will just purge, and it's a 5 or 10% haircut. And
Yep.
if you have cash at the ready rather than being fully invested, having cash at the ready allows you to make gains so much stronger and faster. But you will sit and wait months and months and months or years before that discount is offered. But I do think it's coming. I think something is coming where if we go higher, melt up, enjoy it. I think there's good profits to be made. But I think if you're looking at the bigger picture for maybe the next 1 or 2 years, if you have, let's just time it this way. Let's say that if we had the upside, and this is just my opinion, but if we're sitting here at, all-time highs or close to it, I'd say the upside is about there. I'm just looking at this visually, and the downside is about there. Meaning the average return on the S&P is around 8%, and you're having to take about a 15 to 20% drawdown to get that. So if we go up another 5 or 10%, that means we're talking about a 10, 20, 30% drawdown in order to kind of balance out what these markets have done for decades. Does that make sense?
Yeah.
Yeah.
It's interesting. I mean, yeah, that's the thing, is I think that when you point out some of the bear cases or the cautionary tales, it doesn't necessarily mean you're like, oh, I want to short this thing into the ground, but you're
Correct.
more saying like, okay, look, there's reasons to be concerned. Maybe prices are a bit high in stocks, and having dry powder is just a way of saying when we get, not if, but when that happens, when you
Right.
do get a sizable pullback, you can be at the ready for it. What's up, Tory Trades in the chat? We got a friend of the channel hanging out in the chat room today. That is awesome to see you there.
Nice.
And for everybody who's hanging out today, hope you're enjoying the show. I just want to ask to take a quick moment, subscribe to the channel, thumbs up the show if you enjoy this. We're doing our best here just to bring on different commentating figures and contributors to the A1 Trading Show. Just kind of keeping things real as much as possible. It can be a little bit of a tough year, especially Chris and I have had this conversation 15 different times. When indices are just going up, up, and up, it can be a little frustrating to watch that happen, but also know that you're being practical by saying building cash Because Chris, you've done this for a while. I've done this for a while. You know how this story changes. At some point, markets don't move like this forever. At some point, they pull back, they correct, and there's opportunities if you're ready for it. So, I mean, the one reminder I'll never forget this probably for the rest of my life, Chris, is I was looking at Twitter one day, and it was this year. Somebody, without joking, was like, literally, my strategy now is I wake up and I buy the Nasdaq with leverage, and they were not kidding, and they were showing their P&L, and I was like, that is a great, impossible to beat strategy until you get a year like 2022. I know this from personal experience where I had a massive drawdown because I was way too long tech stocks at the top. So, just from experience, markets and conditions change. What's working very well this year may not work as well next year. What's working not as well this year may work better next year. But the key factor, as we go back to that, Chris, you asked me a moment ago, like, what do I think is going to happen as we go into the elections and the end of the year in terms of markets? I do have my bias, but even if I'm dead wrong, I've got dry powder. I've got my managed risk. I'm not all in on the idea that the market's going to go up. I am leaning bullish into the election period and to the end of the year, but I'm not, if I'm dead wrong and the market's tank, I can't be a fool and position myself to the point where, like, if I'm wrong, I lose everything, right? It's got to be like, because I'm going to be wrong. I am very good at consistently being occasionally wrong.
Very good at it being occasionally wrong. That's a good way to say it. The going into the rest of the year, I do wonder if we have any type of shakeout. Not like an August 5th shakeout, not the deleveraging stuff. But I don't know. Another thing too. I mean, we haven't talked about this, but we're clearly seeing different in polls versus betting, right? Like you look at Polymarket and Kolschi, and now Robinhood is starting to put their hat in the ring. So I mean, these are calling for like 60+% probability that Trump is winning, or that's what the lines are showing right now. I don't know what to believe, and honestly, like I could care less until it actually happens. I'll do my citizen duty and I'll vote next week. Whether it matters or not, whether the popular vote and the electoral college show the same thing, maybe they do, maybe they don't. This is probably one of the least excited. I can't even say, I don't think I've been excited about an election since like maybe Obama came in office. Other than that, it's like I've just slowly and quickly grown to hate politics more and more. I think that our system is an absolute circus, and that's exactly what they want it to be. And everybody panders. And anyway, that's my rant. But point is, this is happening next week. And even with all the earnings and trillions of dollars up in market cap this week, I don't know if we really necessarily go anywhere, because here's where we have been the last several weeks. We have, stretched up post Fed, right? This is our CPI data. This is our Fed. So let me mark a couple things on the chart here. This is that wild CPI day that we had. That was one of the biggest like down and up moves that we've seen in a long time intraday. This was FOMC right here, where the market took on the jumbo cut from the Fed. We carved out new highs, and then we've slowly just kind of rounded that out for right now. Going to last week, we had a big directional day on Wednesday. We came right back up and tested on Friday. Here we are sitting right in the middle, where the market is just, there's good structure here, Nick. I think that, this level, especially that bottom from last Wednesday, it's like we could have price get contained where we're not necessarily breaking any major damage at 57.65, but we're struggling to make all-time highs. And even with the Mag 7 this week, you've got, you've got Microsoft and Google. Google's today. Microsoft, I think, is tomorrow. You've got Apple and Amazon on Thursday. I know you have Visa, MasterCard this week. I've got some Pfizer in that actually faded off the highs, so I'll probably have to roll freaking Pfizer again, which is fine. It's just annoying. But inside, I mean, right now, prices staying right in the middle. So a little bit of a pullback here, fine. Do we get to all-time highs? Maybe. Do we pull back a little bit deeper and threaten anything? There's gaps back at that FOMC or CPI level. I mean, obviously anything can happen. But I think, you and I are probably on the same page where cautiously bullish. I think the market, based on, November flows and typical seasonality, finds a way to justify going higher. Path of least resistance would be that this thing's been put into orbit. It's easier just to stay bullish, and there's no real absence of sellers unless something breaks. And that's why I think we have to watch the yield market. We got to watch the bond market. But look, the Fed so far is continuing to look like they're going to cut rates. I mean, that probably hasn't changed. The inflation data might start to be a little concerning. It may not change anything because, okay, we had CPI print 2.4. Well, let's say next month it prints and it's 2.5. Is that enough to threaten the market with 1/10 off? Probably not. But if we go from a 2.4 to 2.8, 2.9, like that's a big jump, but that might be months away. So
Sure.
if we're talking about this, Q1, Q2 of next year, and all of a sudden our CPI year over year is well above 3%, then the inflation story is right back in the face of the Fed. What are they going to do? They're probably going to pause next year, but I think they're going to cut, and we'll see what happens. I mean, it has been the complete opposite reaction. I think most investors, I mean, myself included. I mean, I get the bond market kind of ran ahead with the Fed cutting rates, but my gosh, man. I mean, I'm looking at the 10-year ripping the way that it is, and I'm looking at the 30-year mortgage has gone up almost 50 basis points, dude. Almost half of 1% were up since the Fed cut, which makes 0 sense. So I do wonder what 2 more cuts get us by the end of the year if this goes down at all. I mean, I don't know. We're going to
Yeah.
go another 50 basis points lower, and this might actually somehow be the same level on a 30-year that it was back in September, which is not making a lot of sense. But
Yeah,
it
it's
is what
almost
it is.
like it's found its, we'll see if it's truly bottoming out or not. But
Right.
definitely going to come down to the inflation and jobs data that we have on Friday, for example. So
Yep.
we will have to see. Chris, if you'd like to go for 15 more minutes, you've got it. If you got to move on with your day, understand that too.
Yeah.
What
I'll go
would
a
you
little
like?
bit longer. I'll go to like 11:15. Is that
Okay.
cool? All right.
Yeah, totally cool. Okay, I'm gonna leave the show to you guys. Remember, if you are not already using the Edge Finder during the free week this week, I just want to plug that one last time before I step out. Edge Finder is free until Friday. If you are not using it and you would like to, we'll drop the link here in the chat to where you can sign up to try out the tool, see if it's the right fit for you. And again, that ends for everyone on Friday. And there you go. All right, Chris, you got the show for a little bit.
All right. Thanks, Nick.
Thanks, man. See ya.
All right. Bye. Okay, just doing a quick spot check. Let's go top down. S&P, like I said, kind of right in the middle of all-time highs and the previous resistance becoming support, which was Wednesday last week. I would imagine price is going to be relatively choppy. I think once the market can say, okay, earnings. Think about this. We might not have direction this week because of earnings, but we could have the reports and the consensus of whether they're beating earnings could be good. Also realize that the earnings expectations have been lowered, so the bar is really, really low. So it might look like we beat earnings, but the revisions have been so much lower that it might be kind of a tricky beat. So I just think, we said this for the last month or so, especially hitting all-time highs through September. August was the pullback, and then that rip in August, rip in September, which is not typically the case. Usually it's called September effect for a reason. We had that post Labor Day sell off, and we're sitting here at all time highs. Now, as we go into earnings season, we were essentially priced for a perfection. And, Nvidia's that case, Mag 7's that case. I think there's still companies that make money. But the one thing we have to be mindful of with the Mag 7 especially is they have been beating expectations so well for so long that what is changing now is like if they start beating expectations with these little tiny improvements as opposed to these leaps and bounds. And if the markets are thinking that this is too high of a valuation, they roll over. And we all know that if the Mag 7 started to roll over price action wise, that the whole market's going with it. That's the double-edged sword of having high concentration and very few stocks leading the charge, which they did most of this year. And then the market has broadened out. We've seen utility sector lead the way. This big play in energy for AI. I think plays, and this is what Nick and I will talk a lot about on the 12th. I'm actually going to add more to my portion. Plays in 2024 towards the end of the year, plays in 2025. I said this earlier, but we'll talk about this a lot on November 12th. So if you want to register for that event, it's going to be a great webinar. I would say that I want to be, kind of inflation proofing my portfolio without taking on a bunch of crazy, like, oh, I'm just gonna go long everything commodities, go long everything energy. I don't think that's the play. I think there's certain sectors to be in. I think there's ways to be diversified. But I'll probably stick to the haystack approach because if the energy sector improves, it could be maybe 5 or 10 companies that do extremely well and it boosts energy. So XLE could go higher. Utility sector, XLU, same thing. If we have like 3, 4, 5 utilities companies that are doing so freaking well that the XLU goes up, it's like that's a safer way to play it than just trying to throw in like, oh, this is beat down. This stock is so cheap it has to go up. Not necessarily true. So I don't want to take the risk of being a, what I think is a value stock that might continue to underperform, because I do think into 2025 especially, it's going to be such an important like identifier to have quality. Not quantity, but quality. And I mean, whatever sector you choose, I want the creme de la creme of quality stocks. So if it's quality tech, if it's quality energy, if it's quality utilities, if it's quality indexes, if it's quality crypto, if it's quality anything, I want it to be companies that make money, don't have a lot of debt, have good earnings per shares, have good growth ahead, are optimistic, have insider ownership. They're not selling at these highs. I don't see, you want to see people leaving the company. I want to see that these are good quality companies with a, let's say a 3 to 5 to 10-year track record of they're proven, they're established, and they have more to go. They have more to gain and grow. That's my thought. So I'll talk more about that with Nick on the 12th. So make sure you're registered for that. To see the team is posting that in there. That's awesome. And then gold. Yeah, I mean, gold pretty much can do no wrong right now, which is great. So if you're holding it, I think gold is a great place to be. I would still love to see a pullback and expect to see a pullback. And if and when we get it, I'll be adding to it. So, I'm long on GLD and it's doing fine. I'm probably sitting on now at all-time highs. I might be sitting on some higher levels in my gold and silver positions. So right now, silver is up around $9,700 on futures. Okay, so I've got 9,700 on futures for silver. I have some gold exposure that's up around 800 bucks. Not too excited there. I've got copper that's up at $900 as well. Fine, that's just throwing that in there. And then my GLD and my SLV are probably two of my better ones. GLD is sitting up around 12.5, so 12.590. And then my silver is up 43.3. So I'm sitting on. So last week when we were at silver highs, I was up around like $73,000. Right now I'm up $67,000. There's a point that I'm going to be happy taking some profit, but it's not yet. Silver hasn't hit my measured move yet. So if I go to XAG, my measured move on silver is to take out this recent intermediate high, get up to 35 and change. I would like to see SLV hit my measured move here. Same thing with the shares I own, 33 and change. I have it covered up to 35, which is a little bit more on the lofty side. So if we blow up there, and I don't mind it getting it called away. If I get it called away, let me see how many shares I have total. If I go into my SLV, 258,000, 1619. So I got 2,200 shares. If I get 2,200 shares times, let's go $33. Actually, 35 would be the call away price. So just on SLV alone, if I get it called away, that's 77K getting it called away. Yes, I bought some shares, but that's a big chunk of profit there. I get $77,000 back if it gets called away. I could also roll it, and I could see that silver could go higher, but I'm not trying to be too greedy on a trade that could be one of my better trades of the year. If we hit this level, I'm happy with that. I've looked at this before. If this is a wave 3, again, if this is wave 1, 2, 3, okay, 4 is a pullback and 5 is still going. So if I want to hold this longer, I think SLV to me could get up into the $43, $44 zone. And I mean, the difference would be decent, right? If I've got 2,200 shares, okay, so I get it called away at 35, I make 77K. If I get it called away at 44, so 44 times 2,200, I mean, minus 7,700. I mean, it's a $20,000 difference in profit. Is it worth the wait? Probably, especially if I can add more to it. That's one thing I will still do on a stock that I really like, or an index, or whatever it is. If I really like it, I'll still add to it. And silver to me technically is still looking pretty good. We can also compare gold versus silver, so XAU, XAG, and this has also been in a multi-year range since the lows in 2022. So where we are right now, this is what I kind of like to see. It's interesting that gold, silver, and this thing is going lower. But yet we're talking about gold at all-time highs, and we're talking about silver just off the all-time highs. But the performance has actually been favoring silver. So if silver gold ratios get back down to this level, I might look at, I don't know, I'll just look at the levels. But if we hit my profit target, maybe I dump my silver and I look to see if there's more exposure on gold, because if gold outperforms, then this chart goes up and gold looks better. But I think both are pretty good to have exposure-wise right now. Just my thoughts. Okay, and then Bitcoin, of course, I mean, that's finally, we've been talking about this for weeks now. I've said, watch this resistance level, and we finally started to test it. And I'm like, oh, well, if you've got a bull flag, maybe post-election, but not even post-election. It's breaking out right now. So, I mean, Bitcoin looks pretty darn good. Technically, this looks as good as I can see on any chart to have this big swing, this big trend, a lot of accumulation here. And the only thing stopping Bitcoin now is its own highs. If these all-time highs actually put it in a pause cycle where we hit and we top out, that would be a little bit more concerning to hit a top here in Bitcoin. But if this is a 1, 2 for accumulation and 3 is just about to get underway, buckle up for some good gains ahead. So if we can blow through, this is probably what's going to be the best momentum for Bitcoin. If we blow through that $74,000 top, and this thing is, kind of destined for 100K, and it's game theory and it's all this stuff, but just momentum begets momentum, and this thing starts to rip higher. I've got a measure to move at 107. Okay. And if we have a pullback and then another measure move towards 135, I believe I'm holding Bitcoin. Okay. So I think the next stop would be if we resist at the 74K mark, I'd be a little concerned that we put in a bit of a near-term top. And that would be more of a range trade, right? So we have this rip up here. We have this big range trade. Maybe that's the case. But if we blow through 74 with nothing but a bull flag, this is looking pretty good. If we blow through this and we pull back again, that'd be an excellent spot to be looking to add some exposure and then looking for higher highs. So I don't know. I mean, if anybody has it, and like I said before, and I've said this for years, it is risk capital, but it is looking pretty good. Technically, it's looking pretty good, and I still think the trade is there. If you're willing to risk it, I think there's some pretty good upside potential on Bitcoin. Gold is already at all-time highs. Bitcoin's creeping up there. I do wonder if Bitcoin, if we make all-time highs, does it drag other stuff with it? Does Ethereum start to get back above 28? Can we get back above this trend line for the first time? I mean, we're not at all-time highs. The Ethereum all-time highs are like 4,800. So if Ethereum can get a surge to break above these highs at 2,800, I wouldn't mind seeing that either. Can Ethereum get back to its recent highs, not even all-time highs, while Bitcoin makes a run? Maybe. Okay. All right. What else? Currency strength-wise today. So pound is on top. Dollar is, look at this noise, man. This is so noisy today. So dollar was strong, pulled back during the news, came back up to strong. Pound is strong. Japanese yen all over the place. Everything else is pretty choppy. We've got 40 and 35 on the vertical axis. Swiss and Aussie are weaker. New Zealand's down there as well. Euros at baseline. Japanese yen at baseline. Dollar and pound are stronger on the day. So let's have a look. I'm going to take a look at Swiss crosses really quickly. Still choppy on Aussie Swiss. That's fine. I'm still holding long. CAD Swiss still holding long. Euro Swiss still holding long. Pound Swiss should be looking better. Yep, Pound Swiss is looking good. Trying to get this one back up towards 117. My ideal profit target is 1950 to 2000. 1.20, 1.1950 on Pound Swiss. New Zealand Swiss has been a bit disappointing, but if this level holds around this 5150 zone, hopefully we start to range and pop back up here. But I'm still long New Zealand Swiss. Dollar Swiss, I'm still holding long. So we've had a really nice breakout, and I'm basically looking at this as like a double bottom. It's probably not a textbook double bottom, but this low is pretty solid, and these highs are very obvious. So if all we're doing is breaking that trend line, which we're already making a nice little breakout here, that was that dollar bear trap we saw on the DXY, and all of a sudden it's getting stronger. But I'm long, dollar Swiss until we get back to 92, and then I'll take my profit. So all these positions I've built up over the last couple of years, 9,200 is a big profit target for me. I'll be happy there. I'll take it. Okay, Aussie CAD, sure. Aussie CAD, I'm still bullish on. I'm just looking at this. If it's this way, that's it. So if we pull back in this channel, find some lows, I'm looking for Aussie CAD just to keep going higher and just to maintain this range until we get up to these highs. So 94 to 95 is my profit target. I'm just staying in a nice channel. Okay. So anyone asking for dollar crosses, look, dollar crosses only matter with the DXY. I don't have any individual opinion on dollar pairs. So I see pound dollar, Aussie dollar, dollar CAD. None of that matters to me unless it's a clear reading on the DXY. This dollar index does not want to stop going up right now until it proves otherwise. So if this keeps going higher, 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 there's resistance all the way back here between like 105 and 106. If we hit the same highs around 107, all these levels, I'm looking to see if and when the dollar turns, does it turn and get a lot weaker? I hope that it does. And that would be a wild year on the dollar to go down 3-4 months, up 2-3 months, and then down again for 2-3 months, or going into 2025 with a weaker dollar. But this range to me is, if you want to be long or short the dollar, this is a pretty good way to gauge it. And I just don't see any reason to be short the dollar right now. There's no reason, there's no technical confirmation to short the dollar. This thing could still keep going. All right. And then it's logical to say, okay, I'm looking for some resistance. Well, there it makes sense. But right now, it doesn't make any sense. It blew through my liquidity levels. It blew through my pockets. And so this dollar has ran through it to show like that the bulls are back in control. And so yeah, pound dollar, like you look at the chart, okay, fine. What do I do with this? I mean, I like the higher time frame offering a dip. If we come back into 200 and get back above it, pound dollar long with a stop loss below, try to break the highs. It could be a really good trend opportunity. But I mean, what would I trade? Well, we have support here, support here, support here. If I wanted to kind of scale into this, if I like pound dollar, I buy it, I buy it, I buy it. My stop loss is below the trend line. Trade small enough that this maybe sets up like a 1% risk. And if you get the direction right, you give yourself, 300 or 400 pips of wiggle room. But if this ends up going up in any way, shape, or form with a weaker dollar, there's pockets and inefficiencies back here. There's all time, there's recent highs at 34, 3,500. I mean, that's how I trade it. I would not be looking to call tops or bottoms on these dollar crosses. This one, it looks really well supported. So if we pull back into, this is a good spot. The 200 has been a bounce for quite a while. So 1, 2, and then trend line support at 3. But stop loss would be invalidation below that. If we don't take out this trend line and we just pull back to it and then start to go higher, you can scale in with your 1% levels, right? And then you can see your reward that's probably offering, 2 to 3% on the gains. Because the scale ins, it's like, look at your risk reward. This trade has the worst risk reward, but then trade 2 has better reward to risk, right? There's your risk, there's your reward. And then trade 3 would be even better. Trade 3 small risk to big reward. So it ends up working in your favor where you have positive reward to risk, but I would trade it over that area. That's what I'm looking at right now. That's what I like. Okay. All right. 11:16. I'll go ahead and wrap it up here. So look, I mean, top down, Nick and I, that was fun to actually have almost a full session with him. Um, the market's doing market things. There's going to be ups, there's going to be downs. If we take a look at our earnings, I did post a couple new trades in my Pulver Alert section today. By the way, I posted a trade on Snap. I posted a trade on what was the other one? Visa. So symbol V or ticker V and ticker SNAP. And then I've got a couple of the trades for AMD this week. We've got earnings right here. So for today, we've got AMD, Google, Snap, Chipotle, Visa. I'm going to add another trade here on Visa because I put that in this morning. So we've got some exposure here. And then coming into tomorrow, Eli Lilly and Caterpillar. I've got a pending order on Caterpillar in the Pulver Alerts. It's not filled yet. I'll keep an eye on that one. Lilly, I'm probably not going to trade. Then we get into the Mag 7 stuff after close. Microsoft, Meta. Meta had wider strikes, and so I didn't take a trade there. But Microsoft, Coinbase watching. Coinbase, I've got some income plays. Microsoft, looking at some bull call spreads by the end of the year. Uber, I want to take a look at it, but it was already up high enough. I'm like, not that interested. Ultra, I've had one of my better plays this year has been just owning MO and also getting the dividends while also adding some covered calls and doing some spreads. So that one's fine. I'm just going to keep that one for exposure. Estee Lauder, Norwegian Cruise Lines, I'm watching. If it's in yellow, I'm watching. If it's in green, I'm exposed with some type of trade. So whether I own shares or have options running, this is kind of my check my checkbox for the week. And then Microsoft, Meta, part of the Mag 7, after close Wednesday. Amazon, Apple, Mag 7, close Thursday. And then we have some big energy on Friday. ExxonMobil and Chevron, if those dip, I mean, I don't mind looking at some dips. The problem with energy is oil prices are not doing anything good. Okay. Oil prices, again, down, 1+% on the day. I'm cautious on oil. And I've said this, look, oil can break these floors and frickin' drop hard. If we break these floors at $66 or $65, we could very quickly be at $55 a barrel. We could very quickly be at $50 a barrel. So I'm not trying to be a hero here and call the support level on oil because I already did it and I already made profit on it. And I'm not trying to call it again. I think I was rewarded considering we had all the geopolitical stuff and prices are all over the place. I'm just going to let oil do its thing. As we talked about with inflation, oil lower is good for inflation. Oil higher, not so much. Another thing you should be watching, let me see if I can find it on this, gas at the pump. Does it show up? I don't know. I'll just find it here. I want to find a trend. Turkey, Greece, gasoline prices. Is there anything in the U.S. here? Come on, man. Let me see if I just go U.S. gas prices. There you go. So U.S. gas prices. Let's take a look at this. All right. So this shows, I mean, I'm not sure how to see this at 0.85. The nice thing is it has been trending lower since about the tops in 2022. Um, I'll try to find a better symbol to use because clearly gas is not 85 cents. I remember that once when I was in high school. It was like 79 cents a gallon, and everyone was so excited that, you know, never to be seen again. Anyway, if this is trending lower, again, this is good for the consumer simply because this is what we see each and every day. Oil prices, as we know, if it cracks below 65, inflationary pressures will help go down with energy prices going lower for now. But if this is going to hold the floor on oil at 65 and gas prices go higher at the pump, guess what? That's not good for consumers. That's going to be higher and stickier inflation. So it will be a story that matters. Maybe it's not right now, but it will matter when all of a sudden the consumers are like, gosh, man, everything's so expensive again. It's felt the same way for 4 years. Okay. All right. I'll let you go for today. Thanks for being with us today, everybody. And have a good rest of the day. We'll see you tomorrow. Thanks. Bye.
Thank you for watching today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. We're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. You can fill out an application with the link in the description below. That's all for today. Trade safe, and we'll see you tomorrow.